I would now like to go over with you some tax planning techniques. I saved this to the end because I really believe you need to have an understanding of the tax code before you try to do tax planning. The first one, we have to actually know the marginal rate and the tax planning that can go with knowing the marginal rate, as well as calculating the present value. So look at number 42 in chapter 3. Reese is a calendar year taxpayer, uses the cash method of accounting for her sole proprietorship. In late December, she received a $20,000 bill from her accountant for consulting services related to her small business. Reese can pay the $20,000 bill anytime in December, but before January 30th without receiving a penalty. Assume Reese's marginal rate is 32% this year and will be 37% next year, and that she can earn an after-tax rate of return of 12% on the investment. When should she pay the $20,000 bill? So should she pay it in year 1, which would be one option, or year 2, which would be our second option? Well, in year 1, what would be her after-tax cost? It would be the actual deduction, which is $20,000, times the 32% marginal tax rate, which is $6,400. So if she pays the bill in December, she would save $6,400 on her December tax return at the 32% rate. So what is the after-tax cost to Reese? It would be the $20,000 less the tax savings of $6,400 calculated above, which means she would her after-tax cost would be $13,600. But if she pays it in the second year, which is the option 2, she's at the marginal rate of 37%. So 20,000 times 37% is $7,400. Well, that is the amount in January of the subsequent year, as in option 1. So what we have to do is take that $7,400 and we have to calculate the present value of that. The present value can be found on page 3-5 in your textbook, exhibit 13-1. Because her rate of return on investment, that top column represents that rate of return on the investment, and you'd go to the 12%, and you would go down the column, which is the number of periods, which would be 1. And when you go across the period time of 1 year to the 12% column, that factor is 0.893. 7,400 times 0.893, which is for 1 year at 12%, is $6,608. We have to bring it to the current year because we're comparing it to the current year amount we calculated in option 1. So if the cost is $20,000 to pay the accountant, and the present value, if she at a 37%, would be the 7,400 times the 0.893, which is $6,608. So her after-tax cost is $13,392. That is less than option 1. So it would be in Reese's best interest to pay that in the subsequent year in January in option 2, because she would save $208. Now, the next question I'd like to go over with you is 52 in your textbook. It's a little different, but let's look at it. Mayona is a single taxpayer who operates a sole proprietorship. She expects her taxable income next year to be $250,000, of which $200,000 is attributed to her sole proprietor. Mayona is contemplating incorporating her sole proprietorship using the single individual tax bracket and the corporate tax rates found in Appendix D in your textbook. Find out how much current tax this strategy could save Mayona, ignoring any Social Security, Medicare, and self-employment tax. How much should be left in the corporation? Well, here's the scenario. Following the directions, you would go to Appendix D and look at the tax brackets for a single person. So if all of her income, $250,000, was taxed as a single person, and you followed the calculation on the tax rate schedules, her total tax would be $62,295. Now, how much could she save if she was incorporated? Well, the easiest calculation is go to Part C. If they could keep $200,000 of the profits retained in the corporation, she would have to pay $42,000 for the corporation's tax. Now, because her taxable income given to us in the problem was $250,000, $50,000 would still be taxed as a single using the tax rate schedules based on the $50,000 of taxable income, and that would be $6,790. So her savings by transferring $200,000 and keeping it invested in the corporation will save her overall $13,505.